Okay, this is Rhonda Thomas in financial accounting, and we're just about to do the two problems we have in chapter 14's coursework. Chapter 14's intro problems are already out there in a video, so now we're going to show how this works. Okay, and I was just saying to the ones that are here in person that we've gone through all these processes of different kinds for the last 4 months of how to make journal entries and how to figure out transactions and that kind of thing so that we can end up with a set of financial statements. But even then, when you end up with a set of financial statements, you need some way to analyze some of that. So analyze and interpret what the numbers are saying. Okay, so this is what this chapter is about. If you like this chapter, you might like managerial accounting a little better. Managerial accounting is a little less of the journal entry stuff and a little more formulas. Now, you don't have to memorize any formulas. Okay, don't have to memorize any formulas because we let you have open resources in my class, at least. We're going to learn, first thing we're going to learn is horizontal analysis, vertical analysis, okay? So what does that mean? What does it mean? Horizontal and vertical, what does it mean? I'm going to show you. Okay, so I'm going to show you a picture of it, kind of like I did when I showed you the cash flow statement. So what does horizontal mean? It means side to side, right? The word horizontal means side to side. Here's what we're talking about. And this one is horizontal analysis of the income statement. Okay, horizontal analysis of the income statement. I'm going to put my spreadsheet in here and I'm going to key these numbers in to it. Okay. Now, if you want to open up a spreadsheet or if you want to get out a piece of paper and write your numbers down, because I think this is an algorithm. Yes, this is an algorithm problem, so you may not get the same numbers that I do. So here's what I'm going to do. I'm going to move this where we can see it a little better and make it bigger. Okay, when you analyze horizontally, what you're doing, just a second, is you are basically analyzing the difference. So when we were doing the cash flow statement, right? Here is horizontal. Let me show you. Here is horizontal. This, I'm going to take these and I'm going to put them in here. Here's what horizontal does. It takes a current year. Now notice I left off the labels. That's okay. This is an income statement. You can do this to a balance sheet. You can do it to an income statement. I suppose you could probably do it to a stockholder's equity statement, but I haven't seen it done that way. But horizontal means side to side. Woo. So what it's doing here is we've got the current column, last year's column for the income statement. Yeah, we've got more net income in the current year than we did the year before. So that's meaning usually a favorable trend going on in this business, right? But we're going to have a column that is for the dollar amount of the difference. So you always take the newest number and subtract the oldest number. See this? New minus old. Okay, you always take the newest number and subtract the oldest number. So this is sales. Now I need to rekey this, and I will. But when we get finished, we're going to see, did our sales go up or down? Did our cost of goods go up or down? Did our gross profit go up or down? And then when we're finished with this column is what they call a percentage increase or decrease. Percentage increase or decrease. Here is the formula for it. a change percentage is new minus old, which is what we have here, but then we divide by the old, right? So let me go ahead and key this in. But what I want you to know about horizontal is it's going side to side to do the comparison, okay? So give me just a second. If you want to put yours down so you can figure yours or do it later, it doesn't matter. But I'm gonna go ahead and key this in. So bear with me just a second, because I got a different problem than the last time I did it, which is okay. And I want my numbers to match just exactly what they have on here. Okay, so I do want to try to be careful. And I haven't been careful, so I gotta go back and fix it. All right, so after 155, 548. There we go. Okay. Yep, that matches. Okay. Go back and think that was already there. There we go. 107. Okay, some of these are subtotals, so I don't want to key them. So actually, the gross profit, yeah, I shouldn't key that. I should only key, right? So the other revenue. Okay, and then the income tax. All right. So here's what we have. Okay. So what you need to do is put the amount of what your calculations show. Okay. So I've already kind of got a spreadsheet set up here that works it out pretty good. And once again, you fill in, so you just simply do the math this way. You take this number and as the base and subtract the old from the new, right? So the old from the old from the new, and then key in what it is. I'm going to go ahead and put the increases in dollars or the decreases in dollars first. Okay, and I'm going to put a negative when I need it to have a negative. Okay, so, and then I'm going to put the percentages in. Okay, so now we have negative 12,300. And then administrative. See, I can't put any formulas, unfortunately, in the input screen here on Cengage. Otherwise, it would really be cool. Okay, so we're just putting the dollar differences down. Now, when it comes to the increase and decrease as a percentage, we want to make sure that we put the minus sign if it's going down, and we want our number to 1 decimal place, 1 decimal place. So let me see how I'm doing here. So one more time, the percentage You just simply take the number you got for the increase or the decrease and you divide once again by the oldest number. Okay, the oldest number to see what that percentage change is. And it'll either be a positive or a negative, just based on what happened. Okay. Be sure you put in 1 decimal place or it will count you wrong. Even if it's 0, put it in so you get it right. And then we'll talk about what seems to be happening here. Seems to be happening in our horizontal analysis of the Macklin Incorporation or the Macklin Corporation for the years 1 and 2, years 1 and 2. We've done a horizontal analysis on their income statement. Okay. I think we all have something similar going on, but let's just look. Now, starting at the top, and most importantly, year 2, we actually sold more than we sold the year before. Do you agree? Right? Yep. If you have an increase here, which I think most of you are going to, then that's a good thing, right? And you want to report what that percentage is. Now, here's where things go south, at least for my company. When I go south, now, no matter what, if you sell more stuff, you're going to have more costs of the goods that you sold. Are you with me? If I sell coffee cups, right? Sell coffee cups, the cost of this coffee cup, I still have to buy more coffee cups the more I sell, right? So that's naturally going to go up. But what's weird about this horizontal analysis is we had an increase in cash or increase of sales of 11.6. And oh my gosh, our costs went up 24%. Our costs, if they're keeping pace with our sales, should go up pretty close to that. Well, our costs are more than double what our sales went up. So the costs of what the amount we're paying for costs has gone up, even though we sold more. Okay. Yes, gross profit. Whoa, what's happened to gross profit here? By the way, I need to put a negative sign there because gross profit actually is less than last year, and we sold more. Does everybody see that? I don't know. Let me check my work, make sure I've got everything keyed in okay. Uh-oh, I got one that I missed. What is it? Oh, I got a couple that I missed. Let me see. How could that be? Huh. Oh. Okay, wrong direction. Oh, costs actually went up. Okay, costs went up. Okay, so I think we want that as a positive. Yeah. Okay, so when it comes to costs, you got to kind of flip it in your mind, right? You got to flip it in your mind. So take the negative off because we didn't actually decrease the cost, we actually increased the cost, and the profit actually went down. Okay, so take off, I should have paid more attention. So now when we compare expenses here, they actually went up. So when a cost goes up, yeah, so it's more. And I need to fix that. Okay, so then total expenses, okay, actually went up. Okay. They went up. And then this last one, our income taxes actually went down. Okay, so you have to be careful when you're doing expenses because you can get them mixed up. Now, I've got them going in the right direction over here. That's good. But, okay, so here's what I have. Let me see if I can make sense. So our sales went up. That's no problem. The amount it went up, and then the percentage it went up. Our cost of goods also went up, which we would expect it to go up some. But if it went up the same amount that the sales went up, the amount over here ought to be about 11.6% also. When that's the case, what happened to gross profit here? Woo! Gross profit, we were making 174,000 last year in gross profit. Now we're down. So this is actually a decrease. And what is it? What's the difference between 11.6 and 24? That's 10.6, just about. Okay, so gross profit went down. Selling expenses, they actually went up by $12,300. Okay, and then administrative expenses actually went up by $5,620. And then operating expenses went up. And operating income actually went down. And other revenue actually went up. So that's a positive thing there. The income from income tax before income tax expense is quite a bit lower than last year, even though we sold more. And our income tax went down. And the reason it went down was because we didn't make as much. So our net income is quite a bit lower. What? 31% lower? And we had sales that went up of 11.6. Does that make sense? It doesn't seem to. But what's happened here is a lot of our costs have risen in how much they are. Okay. Once again, if you sell more, your cost of goods sold is going to go up with it if the costs hold steady. Okay. They did not hold steady. Okay. They did not. And I am going to go back through here real quick. And I need to correct my formulas here for my costs because, okay, so hang on just a minute. So if the old cost or the new cost was $684,400, and we want, let me try something here. Nope, that's not what I want. Okay, I want this minus this, but I've got to do I got to put that in a parentheses that are negative because these are costs. So now let me see. There we go. That's going in the right direction, but then that one isn't. Okay, so then, okay. So costs actually went up. Okay, so then I need to put the, okay. Okay, I think I got that one in, and then this one is just calculating. And that one's okay. So get out of that. Okay, that one's okay. All right, so what I need to do is take the formula here, put this in. So let's do a negative. I'm fixing my formulas from last time. It's not working very well. For when these costs are going the opposite direction. Yeah. Because if costs go up, then it ought to be a positive percentage. If costs go up, positive percentage. If costs go up, it ought to be a positive increase. Okay, so that's why I've got a little bit of work to do here on my formulas so that they come up correctly. Okay, and then that's good. Okay. Those are total operating expenses. Yep. When you're looking at costs, you can't think of them the same way as you do revenue. Okay, there's that. So once again, horizontally going across, okay, 70, 107. Okay, that's good. That one's okay. Yep, that one's good. And this one isn't. So that is income tax expense. Okay. So the question is, all right, what has happened? Okay, what has happened is our net income has what? Decreased. Okay, so I'm putting that down. Net income has decreased by 31%. What? But the sales increased 11.6%. So you'd think we'd at least have something extra in net income, but we didn't. Okay. Costs and expenses increased at a faster rate than the revenue. So our costs are just out of control, at least mine. But costs increased, but costs and expenses increased, but at a faster rate than the revenue. So our expenses are tough. So what's happening here? No, this is not strong earnings. This is unfavorable, according to mine. And costs are increasing tremendously. While revenues are modestly. Okay, so you should be able to start telling a little bit of a story, because when management comes to you in accounting, it says, how did we have net income of 31% less when we sold 11.6 more? And then you got to get this out and make them sit down, and so you can help them understand, right? You can't just go by sales. It's great that sales were up, but those that order stuff, maybe the economy went nuts like it has right now in some things, right? And so net income has what? Mine has decreased. Sales have increased, yes, but the cost of the goods sold has increased at a faster rate than sales, causing the gross profit to decline or decrease. So that's what being able to plug in information into a way to analyze it, help you tell a story. Okay, help you tell a story. Okay, now I didn't put this one in, but I'm going to show you what vertical looks like. You don't have to do one vertically, but I'm going to show you what it looks like because I'm going to have to hurry up here. I'm just going to show you. Vertically means that you're going to compare something in a vertical way. So here's a vertical analysis of an income statement. We just did an income statement horizontally, but now we're going to do it vertically. So what you do is you line up a certain year's income statement and a certain year's income statement. Instead of comparing it back and forth to get these numbers, we're going to take this, which by the way is sales. I'm sorry, I don't have that listed there. That's sales, cost of goods sold, gross profit, and so forth. This is net income, right? This is net income. So everything on here, we're going to divide by total sales. Does everybody see this? Total sales. How do you know which one all the other numbers in this column are being divided by? You go find your 100% number. Go find your 100% number. When you take 1,300,000 divided by 1,300,000, you get 1. Do you not? Yes. So in percentage, that's 1%. When you take cost of goods sold and divide it by total sales, you're going to find that the amount of cost of goods sold is 52.5% of total sales. The opposite, which is the gross profit, right? Gross profit is, these two must add up to 100%. This is the portion of our sales that are the costs of what we're selling. This is what we have left. So for every dollar of sales in year 2, we hung on to 47.5 cents to cover the cost of everything else. What do you hope to do? You hope to lower this. If you can get the cost of the stuff you're selling down without compromising the quality, then you're going to have more left over to cover more of the cost. So then each of these items here all get divided by the 1,300,000. That's vertically. Okay. So if you took a balance sheet and did it vertically, you would divide everything by total assets. Okay. Are we okay with that? I only have so much time, but I wanted you to see horizontal, and we're going to test you a little more on horizontal. Okay. Now let's go to this one. Okay. This is where the sheet I gave you should come in handy. Okay. Should come in handy. All right. I want everybody to notice that these are formulas. You don't have to worry about memorizing them because you're always going to be able to look at the list. But there are a few on here that if you don't practice calculating them, they could be a little bit challenging. All right. So we have liquidity measures, solvency measures, and on the back, we have profitability measures. So liquidity means, and I'll put it down here. I put it in the first video. Liquidity means how quickly can current assets be turned to cash, right? How quickly? Well, cash is already cash. You're going to find out we have an account that we haven't seen before. It's actually more liquid than accounts receivable. And you go, how is that possible? It's called marketable securities. Okay, marketable securities. Do they even have it? Yes, they have marketable securities right there. Remember, assets are listed in the order of liquidity. So which is the least liquid of our current assets? It's prepaid expenses, right? Prepaid expenses would be paying for insurance for a year or whatever. So how would we turn that back into cash? We would have to get a hold of the insurance company and say, we want to cancel our policy. And then they would have to send us back a check. Are you with me? Otherwise, that asset just gets used throughout the year and it never really becomes liquid again. Now, inventories are going to be liquidated when we sell them, right? But we don't sell out our inventory the next day after we have them, right? Even accounts receivable, depending on our credit terms, we may give a customer 30 days to pay us. We may give them 15 days. we may say it's due upon receipt. Just depends on the credit terms. But marketable securities is an even more liquid asset than cash. We don't have to wait for anything, really. All we have to do is call our broker and say, hey, we want to sell our marketable securities because we need cash. Okay, everybody okay with that? So let's go through these. We've got a set of financial statements to work on, and we're going to have to use the formulas that you see on your sheets here. So give me just a second. I'm going to do some keying because, of course, the number that I got the last time is not going to work. So you may want to do this or not. You can watch me. That one's good. Okay, so I'm just putting in what the retained earnings were, the net income. Okay, I'm just putting it in. Okay, and then the preferred stock dividends, those are good. How about the common stock dividends? They're good. Our increase in retained earnings is 785 and 810. Our retained earnings, those are good. Okay, now I'm down here to my sales. Okay, they must have just changed it slightly. Okay, so here is a difference. So let me key these in. And like I said, this all comes from the income statement, the balance sheet. Okay, so that needs to equal that. 2 million, yes, 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 yes. Okay, that looks good. Other revenue, 150,000, 140, yes. This is something's different here. Okay. 10,000, 5370. Yep, there it is. 5370. We want it to look just like this. So if you're going to key it into a spreadsheet or write it down on a piece of paper, make sure that you see these numbers. Okay, and I'm letting it do some of my work for me, of course. So, okay, so now I'm down to here. Okay, so my net income down here at the bottom is the same as theirs. All right, now we're going to the balance sheet. And I got to rekey a few things here. Okay, so good. Yeah. Okay, that's okay. That looks good. Yeah. Okay. Total assets are okay. Current liabilities, 950 and 900. And mortgage note payable, 0. Okay, those are good. Okay, stockholders equity. So this is a lot of information, but you would get it from those financial statements. And okay, I see a difference here. Okay, that's good. Okay. So here we go. Here's what I've done. I've put the formula right here for what you're going to need. Then you're going to have to go up and find the amount and maybe have to calculate a little bit. Okay. So the first one's called working capital. Get this in front of your face. Hello. What's on the phone? Why do you have your phone out? Are you working your problems? Huh? You're not working your problems? Oh, well, it's the second to the last night in class. I'm not going to bug you about it. Okay. It's okay. All right. So the first formula that we need to know is called working capital. We're going to take the amount of current assets and subtract the current liabilities. Okay, so my current assets are up here of 3,700,000, which I have it here. I'm just double checking my numbers are correct. And then my current liabilities are 950,000 and we're doing all of this on year 2. Okay, the only reason year 1 is here is if we have to come up with an average. Okay, we have to come up with an average. So mine is 3,700,000 minus my current liabilities, and there is my value that I want to put in to evaluate my working capital. 2,750,000 is the working capital. What does that do? It measures a company's ability to pay their current liabilities. So you're going to have one called working capital, one called current ratio, and one called quick ratio. All 3 of those help determine the ability of a company to pay its current liabilities. Okay, I'm going to the next one now. Now, the cool thing is some of these ratios use some of the same numbers that we found before. Does everybody see that I've got this column as my what? My numerator. Here's my denominator. So you're looking at a division problem between these 2. Everybody good? Okay, I couldn't figure another way out to do it. All right, so we're going to use that same amount here and use the same amount here. But now we're going to do a division problem. This is your only subtraction one. Okay, this is the only one that you'll get a subtraction, and usually those are dollars, by the way. This is dollars. Okay, this is dollars. This is not dollars. This is a number. So I'm going to put the dollar sign in that first one to indicate that working capital is a dollar amount. Okay, I do like you to at least get that information because that helps to understand that. And I also put which direction. So the higher this is, what? The better, the more opportunities we can do different stuff in our business. Okay. So we're actually always looking to try to increase our working capital somehow, right? Same with the current ratio. Now what this is doing here, and I got 3.89, and they want it rounded to 1 decimal place except dollar amounts, which should be rounded to the nearest cent. Okay, that's how we're going to do it. So I'm going to put 3. I'm just going to put this in and see what it does. I'm going to put in what I got, which was my 2 decimals. I'm going to see if it fusses at me. I don't know. Nope, it doesn't like it. Does not like it. So now I'm going to do what it's telling me to do and put 3.9 and see if that's okay. Is that what, see what it wanted? It wants just the 1 decimal. So, oh, I think I've got it right beside it, I think. Hang on, just a minute. So right beside it, nope, that's just, so I actually need to make sure you understand that I'm going to put in 3.9. Okay, 3.9 is really the answer. That's what I calculated, so I'd know whether I gotta bring up my 8 or leave it alone, right? But now I'm going to increase the decimals here just to 1, and then that is the true amount. So amount to input. All right, so we'll try to make sure we get that in there. All right, the next one is called quick ratio. You say, what is that? Here is the formula. It calls something quick assets, and I have put in from the book what quick assets are. Quick assets normally include cash, temporary investments, or marketable securities. Marketable securities and temporary investments are the same thing. It's just a different name. And receivables, okay? So instead of using all the current assets, we are going to calculate the quick assets. So I should have a formula up here that's going to add my quick assets. My quick assets should be my cash, my marketable securities, and my accounts receivable. Okay, so I am going to, there it is, D91, D92, and D93. So I'm just double checking. Yes, there are the three that I am adding up down below. Okay, when I add those up, I'm also going to divide by the same current liabilities that I did in the other two. So for the first three ratios that we're calculating, we use the same denominator of current liabilities. Okay, current liabilities. I got 2.37, but I'm going to have to turn that into one decimal. So 3.4 or 2.4 should be the amount that I input. Okay, amount to input. And I will change that amount to input. Make sure you change it to a one decimal place. There it is. Okay. So, oops, 2.14 goes in for mine, and you need to calculate yours. Okay, the next one is accounts receivable turnover. So the next four go together. The next four go together. By the way, I want to double check my number, and I'm going to check every number after I get done with it. So if I mess something up, I go back and fix it easy. All right. So the next two are evaluating accounts receivable and inventory. I'm sorry, the next four. We've got two to evaluate accounts receivable and two to evaluate inventory turnover. So the idea of a turnover means that every time we collect our accounts receivable, we're turning it over. Okay, we're turning it over. We're collecting it. We're collecting it. Just like inventory, every time we sell it, we're turning it over, turning it over, turning it over. Okay. So accounts receivable turnover, it takes the amount of sales and it divides by the average accounts receivable. Okay. We know what sales is. It's a specific amount from the income statement, but your average accounts receivable, here's how you're going to do it. Okay, you're going to go up here to accounts receivable. You're going to add these two numbers together and divide by 2, right? Remember, how do you calculate an average? You divide by the number of numbers you added together, right? The average. Okay, so here's where my numbers are coming from. If I go up here and look, should be highlighted now. So I'm going to add these two together and divide by 2. And it turns out that my average accounts receivable is $630,000. Okay, you may have to calculate that. And then this is a division problem. We got 10 million in sales divided by the average accounts receivable. So our turnover number is 1587 when I do the math here, and I also want to put that in as 15.9. Okay, 15.9. So I'm just going to put that in here. There it is, 15.9. And I'm going to kind of pick up the pace now. Now this next one is related to what we just did. We want to know how many days does it take for us to collect our receivables? Okay, so if we're turning it over 15.9 times, are you heading out? See ya. Sorry, I didn't mean to be grouchy. I just was wondering what was on the phone. Okay. Okay, maybe it's all clear as mud. All right, 15, so 15.9 times in a year, right? Okay, so if we do that, we could figure out about how many days, right? There's 365 days a year. Okay, so So 365 divided by 15.7 should be about 23 days. Now you say, huh? Take 365 days, divide by the number that you just got for the turnover. Just give it a try. Okay, if you don't understand it, it's okay. I'm going to divide by that number, 15.9. I got 22.95559. So hang on to that a minute. Now we're going to do what they say to do for the calculation for days sales. I hate that. Who says days? But anyway, we're going to take average accounts receivable, which we've already figured, and we're going to take sales and divide by 365. Okay, so here we are. Okay, this is our average accounts receivable that we just used as a denominator. Now we're using it as a numerator. And if we take our sales, which I've got 10 million, and divide by 365, I get a number of 27,397. Now I'm ready to divide. Here's my numerator, here's my denominator. And I said that it should be about 23 days. Does everybody see that? And we just found that by taking 365 times the number of times we turned it over. And I didn't understand it very well back then either. So it's okay. So I'm going to put 23 days. And I'm going to check it because I don't think we're going to have, yeah, they want whole days. They don't want half a day or 0.2 of a day. That's not mine. I don't want to drink it. Okay. Now we're going to go to turnover, or now we're going to go to inventory and do the same thing. Now, if you need to leave, I'm recording this and you can continue watching it if you need to leave. Okay. But we're going to do kind of the same thing for inventory. Inventory is an asset too. And we want some kind of idea of how quickly we're selling what we have in inventory. We're still measuring liquidity, by the way. Liquidity is measuring from number 1 to, where am I at? To number 7. Okay, these are all liquidity ratios to help tell the story of the liquidity of this business, how quickly they're turning assets into cash so they can pay bills. Okay, so if you have to leave, that's okay. Inventory turnover. Here's what we get. Inventory turnover is the cost of goods sold divided by average inventory. So I'm making my cost of goods sold show up right here, cost of goods sold. And then the average inventory is just like when we averaged accounts receivable. I'm going to add the two amounts and divide by 2. And my average inventory, see you, Daniel. See you next week. Thank you for being patient. 1,075,000. Okay, when I do the numerator here and the denominator here, I get that we turn over our inventory 5 times a year. 5 times a year. Okay, so based on that information, and I may need to put 5.0, I'm going to put 5.0. I know I still got it right, but I'm trying to follow the instructions better. All right, just for fun, how many days in a year? 365 divided by 5. About 73 days our inventory is hanging out until we get it sold. Now let's test that theory in what the formula is. So the formula says, okay, take your average inventory, which you just found from the last one we did, it becomes the numerator. Then you need to take your cost of goods sold and divide by 365, just like we did the sales for accounts receivable. And if we look at it, mine ends up being 73.07. And I'm going to put 73.1. I don't know. I don't know what they want. They just may want 73. Oh, they took it. Now I'm just gonna put 73 and see if they still take it. Just because I'm curious. Do they take it? No. No, they don't. That's interesting. All right. So you do need to take your days to the first decimal, because it won't take it. So the amount that I needed to put in for this one is 73.1. Okay, 73.1. They're being a little pickier than I've seen them be before. So that's okay. Now we're ready to go into solvency measures. We got the ratio of fixed assets to long-term liabilities. Now that's pretty straightforward, okay? But the fixed assets need to be net. They have done that, I think, already for us. And you say, what does net mean? It means all the fixed assets minus their accumulated depreciation. So if I go up here and look at the balance sheet information that I have been given, my PPE or my fixed assets, I don't have any accumulated depreciation. So this must be net. Property, plant, fixed assets is also known as property, plant, and equipment. So I'm going to put that in here. And this is net because I don't see accumulated depreciation. So if you don't see it, then you can assume that it's already been subtracted from both of these years. Okay, so back down here where I go. Okay, once again, this is solvency. So we're going to take the amount, and we just need from year 2. So year 2's fixed assets value divided by long-term liabilities, and you get 2.20. Okay, 2.20. There it is. So once again, these are our solvency ones now. Now we're going to do a ratio. A ratio is always a division problem. You're going to have a numerator and a denominator. Okay, in fact, most of these are division except for that first one. Okay, now we're going to do the ratio of liabilities to stockholders' equity. This is total amounts. So we're going to make it go find total liabilities from my table or from the information that I just put in, and then total stockholders' equity. So if I look here on my problem, my liabilities in total are 2,650,000 divided by total stockholders' equity. So this is 1/2 of the balance sheet. So we're taking the pieces of that half of the balance sheet and kind of comparing it. Okay, so this for me is calculating 0.4, and I'm going to make that go out just a little further because they're being kind of picky. All right, 0.37, which is 0.4. So I'm going to put in 0.4 or 0.04. 0.4 is what I'm going to put in. You might try that and see if that's going to work. 0.4. Is that true? Yep. Okay. You could turn those into percentages, but that's not what they're asking for. Okay, this next one is a solvency, but it's going to involve earnings. Okay, earnings are income. Okay, most of the time, notice you have a return, earnings usually, and return usually is going to indicate income. All right, let's move down here now. So what we want is the income before income tax expense. So that's up here. Income before income tax expense up here. There it is. So make sure you grab that one, not net income. Okay, they want income before income tax. So mine is, and we're going to figure out. Okay, so I'm down here. No, not profitability yet. I'm up here in solvency. Here's where I'm at. my income before income tax expense is 1,280,000. My interest, and that includes my interest too. So you've got to add two things to get your numerator here. And then you're going to divide by that same number that you added to the top. I guess what I really ought to do, well, no, I've got it there. Okay, never mind. So you're going to take income before income tax plus your interest expense. And then you're going to divide by that interest expense. So what this is saying is that if this is our interest expense, how much are we earning? How many times can we pay that interest? We can pay that interest 7.5 times. Okay. The higher, the better. Okay. How many times can we pay the interest? Okay. The lower that gets, the more nervous creditors get. Okay. Because they're like, uh-oh, if something goes wrong, we're not going to be getting our interest payments. Okay. All right, number 11 is asset turnover. Now we're going to start talking profitability. Profitability. So asset turnover, the formula is sales divided by average total assets. Be careful. This takes another little subtraction before you get to the average. So we've got our sales of 10 million. That's no problem. But now here's what we've got to do. We've got to go up here and get total assets and subtract long-term investments from each year. So I've got them in parentheses. So this is year two's total assets minus year two's long-term investments. Okay. Then this is year one's total assets minus year one's long-term investments. So we get a number and divide by 2. So when I do the math there is how much I have. And then we take the 10 million divided by your average total assets that have been excluded of long-term investments. Thanks, John.
Thank you.
Appreciate it. I'm going to continue my video and I'll be posting it. So Misty, if you want to stay or keep going, you do what you need to, but I'm going to keep going. Okay, guys, we'll see you next week.
See you.
Thank you. So my asset turnover. So our sales are we're turning those assets over 1.4 times with our sales. So the higher this is, the better. Okay, so they want that to get higher. Okay, the next one, next three are actually called return. When you see a word return, that means the money we're making on our business, right? The money that we're making and on the business. So I'm going to continue talking to myself. Okay, guys, on Zoom, if you need to bug out, I understand, but I will have this video before I leave tonight. Okay, so if you want to hang out and continue on, you're more than welcome. If you need to bug out, I don't even know. I do have a couple of you still with me. Okay, Rebecca and Chizu, I can't even say it. Uh-oh, nope, she left. Okay, Rebecca, you're still with me. If not, that's okay. It doesn't matter. If you can't stay, you can watch the video some more. Okay. First what we're going to do is return on total assets. So what do you get? Net income, and then you have to add that interest expense. So I've got two numbers. Oh, I need to add it. Okay, I need to add, oh, no, I put that in as a negative. So a negative times a negative is a positive. So I got to leave it alone or it's going to mess me up. I probably had to figure that out last time. So because my numbers are entered in up here as negative amounts, no, they're not. They're not entered in as negative amounts if they're expenses. Yes, they are up here. Sorry. Yes, mine are entered in as negatives if they're expenses. So you know, in order to add something back that's a negative, you've got to subtract it. And if you don't remember that, then that's a rule in, I think, algebra. But there's where it is. So I've got net income plus my interest expense. Then I'm going to divide by my average total assets. Now, these average total assets do not exclude the long-term investments. So they're simply the total assets for each year added together and divided by 2. Now notice this is a percentage, and a percentage. Okay, so all of these returns are percentages as opposed to just plain numbers. All right, so what I've got is 11.3%. And once you get your decimal, then you can turn that into a percentage if you need to by times 100. Okay, so that can help you if you need that. How about return on stockholders' equity? So we simply go get net income as the numerator, and then we add our total stockholders' equity divided by 2, and I get 13.0%. 13.0%. Okay. Then our return on common stockholders' equity. This takes a little more calculation. So we're going to do a net income and we're going to subtract the amount of preferred dividends. So that's what I've done here. Okay. I've got my net income. And so net income minus my preferred dividends. So one more time, if you want to know what those numbers are, there's my net income because I already used it before. And then my preferred dividends, back up here when I put all the numbers in. So my preferred dividends, you just got to find it, is up here. There we are, preferred dividends, right? 45. So we actually, since I've got this in as a negative, I've got to turn it back into something that can be, all right, so back down here. And here we go. I know some of these are a little complicated. So one more time, net income minus the amount that we paid out in preferred dividends. That turns out to be $835,000. Then we have average common stockholders' equity. Now this takes a little bit of work here. Okay, kind of like when we subtracted these long-term investments from the assets. So we're going to start with okay, so I've got D113 and E113. So way up here, D113. So I'm going to take total stockholders' equity and I'm going to subtract the preferred stock from each one of these. So I'm going to take this year minus preferred, this year minus preferred. Then I'm going to add those two amounts together and divide by 2. Yeah. To get your average common stockholders' equity. Common stockholders' equity is common stock and the retained earnings. Okay. But you've got to subtract out preferred amount of stock from this number to get the right number as your divisor, right? So here's what I got. I got 13.3% return, and they want it to 1 decimal. Okay, I think the hard ones are over. Okay, the next one is called earnings per share. Earnings per share is a very popular ratio in finance. So you start with your net income, and if you have any preferred dividends, you subtract them. We did have some preferred dividends. Well, I've already done this, right? This numerator is now this numerator. So we just get to use it again, which works nice. how many shares of common stock outstanding do we have in your problem? So I think that's at the very top. Okay, so shares of preferred outstanding. Oh, you say, well, how do we know that? How do we know that it's 100,000 shares? Well, these are the dividends that are paid out. If you go down here in your balance sheet, here's how you find out. You see the total for your common stock and you divide by your $5 par. That's how I got my shares of common stock outstanding. So that's why you keep par in an account that's separate than it's in excess of par, right? So we take the amount of common stock and divide by 5, and we're finding out how many shares. So when you take 835,000 and divide by 100,000 shares, you get $8.35 of earnings per share. So 835, and this is a dollar amount. Okay, this is a dollar amount. The next one, we're going to use that earnings per share that we just found, right? Remember, it's $8.35. It is in the denominator. Then we have to put in what the market price is of our share of stock. So if we go out to the market, and there it is, the market price, it's way up here, the market price of your common stock. You might make sure mine is $119.70, maybe yours is too. But when you take the market price and divide by our earnings per share, you get a number. That means how many times in the market is our earnings per share in the price, right? So if you take 14.3 times $8.35, you get $119.70. So our price is 14.3 times more than our earnings per share. Okay, earnings per share. Let's check it, and then we have 2 more, and we'll call it good. Okay, the last, hang on. Return on common stockholders' equity. I put 13.3. Let me take that out a little further and see what it's doing. Oops. Okay. Return on stockholders' equity. Return on common stockholders' equity. Okay, so 8. Okay, so we got net income. Let me make sure that I have this right. Just a minute. Well, obviously I don't. Okay, so what am I looking at? It should be net income. So my net income is what? And I'm going to put this below what I found so that I can think about it a minute. So if I take my income, which is 880,000 for year 2. So here's what I'm doing, 880,000. And I'm going to subtract my preferred dividends. So minus 45,000. Okay, so that should be good. Now I'm going to check my average common stockholders' equity. They're saying, and that's going to be down here in the equity section of the balance sheet. So we want to eliminate the preferred here. So we are looking at 7,140,000 minus 500,000. So here's what this is going to look like. So parentheses, I'm looking at 7,140,000 minus 500,000. close parentheses, plus, okay, open parentheses again. Now I'm gonna do the year before, 6,355,000 minus 500,000, close parentheses, divided by 2, close parentheses. I think I've got it. Okay, so there is what it should look like. Now why? Okay, so what I'm gonna do, it said to take it to 1 decimal place, but it doesn't like it. So I'm gonna go down 1 and see if that's it. I'm gonna go up 1 to see if that's it. Or I might have a wrong number somewhere. That was it. I don't quite know. Okay, let me make this go out further. I don't quite know why it's wanting me to round up, unless this is up. No. So all I know is I don't think that was right. I don't think 13.4, because that is return on common stockholders' equity, and I think it's wrong. But to get it right, round up to the next number if yours is showing that it's wrong. Okay, so I'm sorry. I don't know why it's doing that. It would be nice if it didn't. But, so this is the amount to input. Amount to input. All right, we're almost done. Dividends per share. Dividends per share of common stock. So what we want to do is take the dividends that we send out to common stock, that's 50,000, and then shares of common stock outstanding. We've already figured that out up here when we did this one. Remember, it is the common stock amount divided by par, right? 500,000 divided by 5. That's where we're getting our 100,000 shares outstanding. If you take the dividend total of 50,000 and divide by 100,000, then this needs to be, it needs to be there we go. You get 50 cents dividends per share. That's how much dividends were 50 cents a share was going out to all the shareholders. That wouldn't be a whole lot unless you owned a lot of shares. Now we're going to do something called dividend yield. When you see the word yield, it's kind of like the word return. Notice it has a percentage. Okay. So sometimes returns are called yields, and it just matters what you're looking at. So we're looking at dividends per share of common stock, which we just found in our last calculation. And then we're going to divide by that market price that we had up here of 119.70. And when we do the division and take it to 1 decimal place, which I'm going to increase, I think we're looking at 0.4 is the dividend yield. Okay, let's see if we're right. We got it. Okay, that's going through each measure and ratio that the chapter talks about and where it comes from. And yes, you have to be, it's better to put it in a spreadsheet like this than to try to calculate each thing all by itself, because you can go back and find something if you missed it. So that's all I've got. Okay, so I am going to say goodbye for now and put this video out on Canvas. Okay, guys, I don't think there's anybody left, but if there is, I'm ending it. We'll see you on the next video.